I felt a little guilted into doing something with the stock market.
You guys are idiots. Look, the stock market is not where people get wealthy. Absolutely not.
So it's kind of a one man's risky investment, is one man treasure type thing.
Wasn't so that people could raise capital. It's so they could take money off the table and exit.
And what's the difference?
They don't care about the value.
There's been a lot of changes in the stock market, and it's not going well.
And so here's these people, like I sold my company and now they're doing things I would have never done. That's not a financial planner. That's a salesperson.
Yeah.
Most people just automatically are indoctrinated.
They did a really great marketing job of convincing people that it's the only way to prepare for retirement. Okay, Garrett, I was talking with my father-in-law. I don't have a retirement thing set up. He's got quite a bit of money in the stock market for his retirement. And I felt a little guilted into to impress my in-laws better by doing something with the stock market or something for retirement, I guess.
Stocks are synonymous with investing, just like Kleenex is synonymous with tissue.
Yeah.
Kleenex is the name brand. Stocks is one form of investing, but most people just automatically are indoctrinated. And by the way, the stock market is not where people get wealthy. Absolutely not. You know, there's a saying that says, how do you end up with $2 million in the stock market? You start with 3. Now, it's not quite that bad, but I want to go deep into this philosophically to uncover it fully. So it's not just conjecture and not just opinion, but understand where it started, why it started, how it was brilliant and how it initially worked, and where it actually landed today, and where most of the wealth is actually made and lost, and where that's outside of the stock market, and where we're bamboozled with the stock market that's actually harming our actual peace of mind, our ability to have exponential wealth, and actually generationally make a huge difference. I'm going to dive deep into that.
Okay, so then where does it start?
Well, let's talk about, like, who's the stock market for? So, yeah, you don't have to think about it. You just set it aside. You put this in retirement plans and things like that, meaning they don't have the knowledge of what to do. Maybe they inherited money. Maybe they just have a salary and they don't want to put any time into learning how to invest.
Yeah.
The thing is, you know, the lower half of the market, maybe the lower 20%, is going to average around 7.5%. And the top 20%, it's going to average 9.5%. So there's not a lot of variance, right?
Yeah.
So that creates, even though there's volatility and it might go up and down, it's trending upwards, right? Mm-hmm. My problem with the stock market, number one, the fiduciary rules. And this will be, you know, interesting for people to think about, is they have to grow.
Oh, to increase shareholder value.
So they can't ever have a place where, like, we're in a good spot, this is where we want to be. It's always about more. So this is why we've seen companies that are incentivized to make short-term decisions that aren't really good long-term. We see them with reporting that seems a little bit, you know, less than accurate is the best way to say it. But the stock market was created for a pretty amazing purpose. See, when companies need money, someone has some huge idea, right? They're like, we want to build and we need a lot of infrastructure. So if they need a lot of infrastructure, it might take a lot of capital to get that. Mm-hmm. They can't just bootstrap. Small companies can bootstrap, right? They can say, look, we're going to start with $5,000 and we're just going to take company profits and we're going to reinvest those.
Feed it back in.
Right? But if it's something that's global, you know, an airline can't do that.
Yeah. Yeah. You got to buy a jet for, you know,
right.
10 million, 100
So they
million.
raise capital. Well, back in the day, the ways they would raise capital was either through debt or equity.
Okay.
Okay. So let's start with debt. That's bonds. It could be a corporate bond, right? And there's different corporate bonds to corporations. So we've got government bonds. So you hear about, like, there's T-bills, there's notes, and there's bonds. Mm-hmm. And those are different just based upon the duration, like when they mature. So let's say that, you know, you gave the government $1 million. You might have one that matures in 6 months, or you might have one that is 10 years. And it says, hey, we're going to pay you 5% on this bond. And then if you wait the full 10 years, you get back your $1 million plus the 5%. It could be a corporate bond, right? And there's different corporate bonds to corporations.
But it was the same principle, right?
One might be a junk bond. So a junk bond is a smaller company, less established. So they usually have to pay higher interest rates to attract someone to give them money because there's more potential risk. You just have the regular corporate bond, that you could do, but there's also something called the municipal bond. And these have tax advantages. So some people might be like, oh, I'll take this 3.5% municipal bond because I pay zero tax on it. And if it's triple exempt, meaning you don't have to pay city tax, state tax, or federal tax. If they're in the highest tax bracket, that might do better than a 4.5% corporate bond.
Oh, interesting.
Right? Because this has to be taxed.
Yeah.
Where you have one with no tax. Okay? So those are debt instruments. And debt instruments, like bonds, have higher priority. Meaning, if that company goes bankrupt, they have to pay back the debt before they pay back equity.
Oh, gotcha.
Right? So equity is the stock market. Equities are known to be a little bit higher chance of volatility, but higher chance of growth.
Gotcha.
So when you buy a stock, there's one thing called an IPO, initial public offering. So this is the companies, saying, hey, we're doing an IPO.
Yep.
And they'll have an underwriter. This is like one of the big companies, like a JP Morgan or a Chase or a, Goldman Sachs. And so they're building the process of going public. And then they'll have, here's what the stocks is, right? The par value, like here's what you're buying it for.
Yeah.
And that's also called a primary market because you're actually buying it and giving the company the money. After that, after IPO, it goes to the secondary market. Secondary market, you might hear of like the NASDAQ or the, basically the New York Stock Exchange, right?
Yeah.
So those are secondary markets where people are buying and selling. When you're buying and selling, you're buying the stock from someone else, not necessarily directly from the company anymore.
Oh, okay.
Right? So it's just, by the way, all based upon, if anything, I guess it's kind of supply and demand to a degree.
But there's a lot.
But I want to tell you, it's all about perception.
Yeah.
Right? So what is it that they think? Do they think that company is going to go up in value? And there's something called a price to earnings ratio. And it's maybe like, hey, I'm giving $1. That's the price. But that dollar, they're not earning, they might be at like a 20x where, for every dollar, that company, you're really saying it's a 20 PE. You got like, it's really not, it's like 5 cents is actual earnings.
Yeah.
It's all perception, right? So that's why you could have companies like, let's use Enron was a public company. It might be worth $57 one day. And then the next day, it's worth nothing. Why? Because they found out about fraud.
Yeah.
It was all based upon all these rolling blackouts that were happening back in the day. It was because Enron was an energy broker and they were lying about what was going on. They were fabricating and cooking their books. And so once the fraud was understood, everybody went to sell. But who wants to buy a fraudulent stock?
No one's going to buy into it.
So the secondary market, some people call this the greater fool theory. Right? Are you buying at the peak? And if you're selling it off to someone else, they might lose 50% because it goes down in value. It might be at $100 this day, and then, later on it's at $50 because that's what people are willing to pay for it. It's supply and demand.
Yeah.
What are they willing to pay? If that's in high demand, then the price keeps going up until people no longer want to buy it, and it starts to stabilize. So you'll hear about like trading volume and stuff like that. So ultimately, why do they say greater fool? Because they're like, well, who's the one that's buying when it's at its peak? And when people say, oh, this person lost 50%, they didn't lose. This person gained. The money wasn't lost.
It was transferred.
It was from one pocket to another. This person sold at 100. The money actually went to them in exchange for a stock certificate. And it's what can you sell that for?
Yeah.
Again, all perception. So back in the day, people could go public to raise money.
Okay. And that was the unique invention.
Really cool. And what's really good about this is it's pretty liquid.
Yeah.
You know, when you buy a private company, you have to find someone else to buy that. On a stock exchange, you just say, you put in a sell order and it sells for whatever someone's willing to buy. And there's so much exchange happening that it moves quickly. Mm-hmm. Private, that might not happen. But here's the thing. In the old days, people went public to raise money, right? They want to get that money. In today's world, most companies go public, take money off the table. It's an exit.
Oh, interesting. Oh,
they're going, hey, we're going to go public, and then we now get a cash out.
Because they already have a bunch of private investors.
Right, and this is the thing. The private market funds almost everything. But the thing is, in the private market, the top 20% might be getting like a 24% yield.
Uh-huh.
But the bottom 20% are losing money.
Interesting.
So look how much more volatile it is, right?
Yeah.
So it's about liquidity. Now, my issue with the stock market is when people started to put money into retirement plans.
Uh-huh.
We can go to the early days of pensions, right, which were companies putting money in. Now what you have is what are called qualified plans like IRAs and 401ks. So you have individuals versus companies, right? And in a pension, you were told, hey, we're going to have a pension for you, and this is what you're going to get based upon how long you work here.
Yeah.
An individual is basically, you don't know. Just depends on what the stock market does. And by the way, a lot of pensions went bankrupt. Why did they go bankrupt? Here's why. They said, all right, we're going to put money into this pension. By the way, they had millions and millions and billions of dollars. So they're getting the best money managers, right? Because they have so much money. And then when the market's volatile, goes up and down, they had a problem called disinvesting. Disinvesting, we know what investing is. You put money in and hopefully over time it grows, right?
Yeah.
That's investing. Disinvesting is it's time to take money off the table. And the problem is if you lose 10% that first year, so it's $1 million to start with, now you're down to 900,000, but you're trying to take out 10% because you're predicting a 10% return.
Uh-huh.
Now you got to take an extra, take an extra $90,000 out. Now you're down to $810,000. And now when the market comes back 10%, it's only 10% of 810. So what happens is when you take money out, it disinvests and it starts to kill the account.
Yeah.
And so when they had to start paying out pensions, they might have said, hey, we're going to assume an 8% return. And even if the market averaged 10%, it could still destroy the pension. Here's why. If I have $10,000 and it grows by 100%, I'm now at 20 grand. Amazing.
Yay.
But if I lose 50% the next year, I'm back down to $10,000.
Uh-huh.
But it looks like 100 minus 50 is a positive 50. If that was over 2 years, divide by 2, it's a 25% average.
Yeah.
Right? So it looks like it's a positive, but in actual, you had a 0% return, but you also had to minus the fees. Right?
Yeah.
And what if there was a distribution in that pension in a down year? And what if it was 2000 through 2003?
Yeah.
Those were 3 straight years of negative double digit, 10% or more, right?
But pensions weren't always based off of the stock market.
No, they used to, if we go back, let's go way back, 1947. GE, big company, right?
Yeah.
Conglomerate. They had multiple divisions. And they said, hey, if we're not number 1 or number 2 in our divisions, we need to recruit or we need to sell. So we either have to find the best talent. Think like what the Bulls became when they got Michael Jordan.
Yeah.
Much better team. Same uniform, same stadium, but new talent. So they said, we got to recruit the talent. How are we going to recruit talent away from our competitors? They offered a pension. Hey, if you come and work here for a certain number of years, 5 to 10 years, help us get to number 1 or number 2, you're going to get this pension. So how'd they fund the pension? Well, this worker would start with them. They'd say, all right, we're going to buy some life insurance. This life insurance is going to have cash value that grows over time, but also has a death benefit, right? What would happen is they'd use the cash value to supplement retirement, to supplement the pension.
Yeah.
Maybe they could fund it in full dependent on how long will the person live, right? That's what it really depended on. But here's the deal. The GE was going to be around longer than these 50-year-old executives.
Yeah.
So when that executive died, the death benefit came in tax-free to refund plus a return. And it worked fabulously.
Yeah.
Then Wall Street comes and they're like, you guys are idiots. These things are getting like 5% at best with your cash. The market's doing like 10% since 2000 BC.
Yeah.
Right? 10% average. We're going to double this for you. But they didn't think about volatility and disinvesting.
Gotcha.
And so those negative years destroyed the pension.
Interesting. So really the pension worked great when it was based off of a different system.
They needed more risk managed assets, because if you have predictability with like things like dividends, interest, and you had 0 negative years, you could have more longevity. But they'd have to potentially put more money in it to provide that pension. So, and then we had qualified plans. People were automatically putting money in all the time. And again, we go back to supply and demand. If people are doing something called dollar cost averaging is you're putting money in every month, no matter if the market's up or down.
Yeah.
So you're buying kind of at an average price, right?
Yep.
Instead of just the highs and the lows. So what's happening is we're driving up demand because more money's going into the market, which is driving up the price of the market because more money's coming into the market. When people take money out of the market,
it drives it down.
It drives it down.
Yeah.
So what happened was people are like mindlessly putting money in. And that helped to increase demand. And so you have people that don't know what they're doing, just setting money aside, hoping for the best and going, I'm in it for the long haul. I just got to take risks to get the return. I'll just keep adding money in. We saw that especially become exponential in the 90s.
Yeah.
What a 10-year bull run, right? And so, great. The problem is now we have all this private capital that comes in, and it gets a lot of the growth in those early phases of the company. And then when they finally go public and they're bigger, it limits what the return is. And ultimately, wasn't so that people could raise capital, it's so they could take money off the table and exit.
Yeah.
That's the issue I have with the stock market. And that the fiduciary responsibility is only to the shareholder, not to the employee or the customer. And so it creates where, you hear a lot of people just frustrated about the greed.
Yeah.
And by the way, there's this huge conflict of interest. What's the conflict of interest? Well, if you watch on Apple, there's a series on WeWork. And, they're going and they're interviewing underwriters when they were going to go public. And they're saying, we want it to be at this valuation. We want to say that the stock is worth this amount. See, if they go too high, right? Let's say that they start with a $100 stock price. And then all of a sudden when it goes to the secondary market, people are like, that's not worth $100. I'm not spending that. And people go to sell, the price starts to drop. And the conflict of interest is they're interviewing all these underwriters, all these big firms, and trying to get the biggest possible number. Why? Because they're taking money off the table.
Yeah.
They're not actually thinking of what the very best thing is for that, individual that's about to buy the stock. And they're actually creating this, moral hazard of, hey, this Goldman Sachs said they would do it for more than what you're willing to do. And by the way, when they go and say, hey, do you recommend to buy or sell? Because guess what? These people offer securities, right? Securities are the equities. They're the stocks. So you have all these people at JP Morgan selling stock. You have JP Morgan underwriting the stock. So now there's this huge incentive for everybody to buy that stock, right? And what happened if that stock was overvalued? Because there was pressure that if they want to be the ones to underwrite it and make the money making that go as an IPO, you have a conflict. And every single time, you could just see, you watch time after time, there's always a positive buy sign by these big companies. Oh, this is a great price. Buy this stock, because they can't give you qualified advice because they're making money on both sides.
Yeah.
It's a problem. And most people don't think about that. Weston, we also have to talk about all these other issues that came in life. I read a book called Flash Boys. Amazing book. And what happened is people built supercomputers, right? They were putting like crazy fiber all the way through New Jersey to get into Manhattan. And they were ultimately just saying, all right, let's say here I'm an individual. And I say, hey, I want to buy 100 shares. And what a supercomputer does is it comes in and buys the share before I can, and then raises the price a little bit. And then I buy, and they skim. It's a skimming operation. And it took them time to figure out what was going on. There was things, if you've ever heard of flash crashes.
No.
It's because the computers are doing the skimming, and then all of a sudden it crashes because, the buy doesn't go through and it starts to drop.
Oh.
Because of the way the activity works, because there's so much trying to be sold. That's a rudimentary version of what a flash crash is. So not only do we have people taking money off the table, right? Because they're worried more about an exit than raising capital, because it mostly happened through private capital.
Yeah.
We have flash trading, right? We have, if you're in a managed fund, you have expense ratios. This pays those fund managers. You have 12B1 fees. Those are the marketing fees they could charge you. And a lot of these are in those qualified plans, which means there might be legal fees, admin fees. There's a myriad of fees. There's custodial fees, which is like a custodian's almost like a bank for a retirement plan. So there's all these fees. And the deal is, like, let's see if I could pull up a calculator here and just show you the impact of this. So here's a compound interest calculator. We're going to start with $100,000. We're going to say that you can get 10%. Okay. We'll look at 20 years. We're not going to add any money to it. All right. So let's look at this graph here.
Yeah.
So you grow to almost $700,000 off your 100 grand over 30 years. Awesome, right?
Yeah.
What if you have a fiduciary fee, which is 1% to your financial advisor? What if you have a 1% expense ratio, which is for the fund manager?
Is that pretty common?
Oh, yeah. Very common, especially if it's not an index fund or an ETF.
Yeah.
And what if you have another 0.5% for 12B1 fees and legal and admin fees? So let's just say that you're now at 7.5% instead of 10. Let's just see the impact that this has. So now it grows to $424,785 instead of almost $700,000. From 2.5%.
And that's just from the fees.
Just from the fees.
So the stocks still perform the same, assuming the stocks still perform the same, it's just the fees.
Just the fees alone. That's called compounded cost. Right? We know about compounded interest. What about the compounded cost?
Yeah.
So if it wasn't bad enough with everything we talked about, there's also something called dark pool investing.
Wow. That sounds intense.
It's that institutions are buying at a different price than the public.
Oh, why?
Because they've got money. So this is my problem with the stock market is there's a lot of factors that harm someone's return.
Yeah.
The cost of the retirement plan, the cost of the management, the cost of the, fiduciary. There's just, all these different factors working against someone. Not to mention, we are mentioning it, if you got to take money out, you have a disinvesting problem. There's something called the 4% rule. And it says if you take more than 4% out of a variable or volatile account, and you take more than 4%, you run the risk of crushing your principal, losing it. So, a lot of people are putting their eggs in this basket called the stock market, not knowing what it actually is, how it actually works. Now, let's make it even worse. Let's say that you're in an S&P 500 index. Let's say that you think that AI might be so disruptive that some of these 500 companies won't make it. So let's say that you are getting 10% on your S&P 500. It's basically you're getting whatever your money is spread out amongst these 500 companies, but one of those companies goes bankrupt.
Yeah.
So what happens is you now have 0 that you're making on one of those companies, You still have money that you're making on the 499, but now they're going to add a new company, right? They have to put in the new 500th biggest company.
Oh, gotcha.
But guess what? They're not going to run your average return as 0 on that stock that you lost. They're just going to show you what the new 500 are doing. So they might say, hey, S&P is getting 10%
average,
but they're not saying what the actual average is of your S&P 499 because the one company that was lost. Yeah, moving forward, whatever that new stock gets impacts the return moving forward, but you have a permanent loss on the company that went under. Part of the reason why people argue for diversification, not having all your eggs in one basket, not just owning one stock, all of that. But like, this is the stuff that most people don't know because they're not being told. It's like stocks is one form of investing, but most people just automatically are indoctrinated. And by the way, this is why BlackRock is massive. That's why they're, I don't know how many trillions.
Yeah.
Trillions and trillions of dollars. I think that there's 22 trillion in funds. Those are mutual funds, including index and ETFs and all that kind of stuff. You have $22 trillion there, which are mostly controlled by
a single entity.
Vanguard and BlackRock. Now, what is BlackRock investing in? Everything. Real estate development. They're making a ton of money, and you're giving them the money, not knowing what the money is actually going
what
to.
they're doing with it.
Right? So, if people want to do it, great, do it, but know what you're getting into.
So with that, do you notice a trend? Are people growing less trustworthy of the stock market, or is it something that's sticking around?
Now it's sticking around because you'll hear this term, fiduciary, which says, I have to put my client's best interest. Sounds great, right?
Uh-huh.
But guess where the majority of fiduciaries put the money? In the stock market. I was just meeting with one of my clients, Daniel, today. And he's like, there's a term called AUM, assets under management. He's like, I don't want to do AUM because he has a 9-figure business. And I'm like, yeah, you can grow your business. And then it's just a matter of how you translate that to personal wealth by capturing it without taking a bunch of risk. Now, let's talk about another kind of issue that happens here. So there's a lot of ignorance around the stock market. There's a lot of automation. And there's people that say automatically save.
Yeah.
Okay? The problem is most people are not automatically saving. They're automatically investing.
And that's not the same.
It's different. Automatically save is I'm putting money into cash value of my insurance. That's more of a savings thing.
Yeah.
I'm putting it in a money market. I'm putting it in a CD. I'm putting it in a savings account. I'm putting it, in those types of things because they're safe, they're stable, but they're also slow.
Yeah. Not as high of
They're
interest.
also low interest. They're less volatile, right? But those are savings. Investments, stocks are investments, not savings. Yet somehow we've collapsed that term, savings and investing, into the same thing.
Yeah.
And so what it gets people to do is mindlessly put money away. Well, I run ads to sell books.
Uh-huh.
And sometimes we'll spend $1 and we'll get back $1.50. And then we just go, well, let's go ahead and do more. But there's sometimes the ads change. And all of a sudden we put in $1 and we get 40 cents. We make adjustments. People are taught to be mindless and not to adjust. You've heard the terms. You're in it for the long haul. That means no accountability. Just wait. Set it and forget it. Dollar cost average. Automation, but it's automatically investing. I believe in automatically save, deliberately invest. That's my methodology. And by the way, really wealthy families, that's how they do it. When we were going into 2020, we had about 37% of the wealthiest families had money in cash or cash equivalents.
Wow.
Because they felt like we had too much of an economic run and they thought things were overvalued.
So they pulled if they had money in the stock market, they pulled it out.
They pulled the cash, and then what they were waiting for is for a dip where they could then buy.
Gotcha.
But everyone else is taught, oh, don't try to predict the timing. You're never going to get it right. You don't know when it's going to be high or low. Just dollar cost average, buy it in an average thing. Well, yeah, if you want to be average, that's one thing that you can do. But what I look at is, when I've got money, I'm saying, what level of control do I have? How do I manage risk? How do I create cash flow? These are things that are really important to me. Do I have liquidity or access? Right? And I go, all right, I'm willing to be more active where some of these people are being really passive. My stocks are my businesses. That's my stock. I can hire the employees. I can allocate marketing dollars. I can learn and grow. When I put money in the market, I don't grow. I don't personally grow, even if it grows. I don't know why it went up or why it went down. I can speculate and talk about all those things. But another issue I have is there's some people, and I've had friends do this, where they have a small company and they go public. Right? They're like, hey, we want to be public, and then we'll be traded. But the problem is they might be being traded for like $1, $2, and then you get the sharks. The sharks come in and go, here's a really small company with a low cap, right? Like if we look at the whole value of the stocks, it's 10 million. That's a very low cap.
Yeah.
Very light volume. There's not a lot of trading going on. So what they do is something called selling short. So they sell short. So when you're long, you think something's going up. When you're short, you think something's going down. And that's fine if you just think that. So it's basically you can buy an option that says, hey, I'm buying at this price. If it goes down, I get that money. The person that goes long loses the money. So it's going back to that story when I say, hey, when you got money and you go, hey, I bought it 100, it dips and now it's worth 50.
Yeah.
Well, you know what? You lost $50, but the person that sold short could have been the one that got that $50.
So they're kind of betting on.
Yes, it's a gamble that it's going to go down. But here's the thing. It's not just a gamble. There's something called naked short selling. A naked short. They basically put downward pressure by shorting the stock to death.
Oh. So they try to make it look like it's going down.
They push it because it's so small and it crushes it. And sometimes it's hard to see and it's not, and it should be illegal, but it's not. So if you're going to go public and you're considering that, but you're a small company, you really have to consider you're in the water of sharks. I know there's tons of movies about mergers and acquisitions and leverage buyouts and forced buyouts. Yes, this is all kind of what happens in the money game when they're devoid of value and not thinking about personal. So what I know is this: entrepreneurs get paid for value, right? And then they get this dream and this idea, I'm going to sell my company. And so what they do is they try to grow that company's EBITDA. You'll hear this: earnings before interest, taxes, and depreciation. EBITDA. Depreciation. Okay. EBITDA. So that's usually when people are talking about that a lot, they're thinking about selling their company. Well, they might be selling to venture capital. So here's the model of venture capital. This is private equity, right?
Yeah.
Private equity that's not public yet. Venture capital. Hey, they want to buy companies and do what's called roll them up. They want to keep buying more and more because then they get a higher, valuation, right? What they're looking for is how can they get a multiple? Maybe if it's a small company, they get 1x or they get 2x. But if they buy enough companies and have enough revenue, maybe they can get 15x. Like if there's a dentist that has one dental practice and they just sell that one dental practice, they're kind of selling their patient list in that one practice. But if it's a dental service organization, DSO, they might buy a ton of practices, right? And all of a sudden they have certain systems and processes. And now the more they have, the higher the multiple.
Yeah.
Okay. So now this is the way venture capital works. They might fund 10 companies or buy 10 companies. And they might go, this is the unicorn. One of them takes off, right?
Yeah.
2 others are doing well, but they're not crushing it. And 7 they think are slow or they're not doing well. They'll kill these. They might even kill this because this is where they're getting the return. They don't care about the value. So what happens is the entrepreneurs create the value. The venture capitalists extract the value. That's why they earn the name snakes. And so here's these people, like I sold my company and now they're doing things I would have never done. I saw an ad there saying it's your $5 latte that's killing your finances. That's completely against what my brand was. They're like, hey, those people that pay taxes up front are foolish. You need to defer your taxes out with the wealthy. No, they're selling AUM so that they can get a 12 to 15 times multiple on that book of business. So this, this is my issue is like, if we're devoid of value, then it's just pure, zero sum game.
Yeah.
And so there's a few zero sum games. Options trading is zero sum. So we have calls, which you think it's going up. You have puts, you think something's going down. So puts is selling short, calls are being long. One person gets the money, the other person loses.
Yeah.
It's a gamble. There is no real value creation in that.
Yeah.
And so when I'm saying you're buying on the secondary stock market, what value are you providing? Well, you're providing liquidity, I guess, right? Because the more people that are buying and selling, the more liquidity there is. But you're not actually driving any value for that company. You're simply gambling. And that's the problem is there's too many people that gamble and think they're investing. And so I did an article in Forbes. In this article in Forbes, we were doing some research. And what we found was 84% of the return in the market came from 10% of the investors. Okay? Now, at surface, it's like, well, maybe the 10% has the most money. But that's where we have to understand there's something called hedge funds. Okay? And a hedge fund, they can do options. So they could get 10% because they sold some short and went long on others because they might have a really sophisticated software and use AI. Or they might just have the most brilliant minds in the world and a big team of researchers. Where someone else only got 3% that same year. Why? Because of hedging, because of options trading. And so the market may have averaged 7% that year. That doesn't mean that the average investor got 7% because flash trading might have skimmed them, expense ratios might have taken money from them, and hedging might have been where a lot of the return came from because of when it was bought and sold, because we're looking at a whole year, not just from month to month or day to day. And this is why I'm passionate about it, frustrated about it. And this is kind of a fairly detailed kind of like explanation of bonds versus stocks and public markets and, secondary markets versus primary markets with IPOs. Yeah. And there's just too many people that are just throwing their money into something that's controlled by this, Weston. Wall Street. Do you trust Wall Street?
No, but I think you kind of prove a point in it. That is so complex and so there's so much that you would have to know.
We're talking about one person versus a team of experts.
Yeah.
And by the way, you have to have usually minimum funds, a minimum, like a small one might be like $100,000 minimum for a hedge fund. There might be some that are like, there's some that are 100 million minimum to be invested.
So it seems like what they've done is they did a really great marketing job of convincing people that it's the only way to prepare for retirement. And then they've
done a brilliant job. And how they did that was through compensation. They have an army of fiduciaries
who they are incentivized to
sell it. Selling stocks. And if they build $1 billion in management, right? If they got $1 billion, then they're probably going to get 12 to 15 times what that net revenue is when they sell that book to someone else. So they've got this huge force of people that say that they're financial planners that are glorified salespeople.
So it's kind of like the biggest multi-level marketing thing in the world, but look, with the product per se.
Here's how you tell whether you have a financial planner or not. Are they making sure you save tax or just delay it? Are they making sure that they have a team that can help you set up the right corporations if you're a business owner? Are they looking at your cash flow and how you structure your loans? Are they making sure you have insurance to transfer risk? Do you have other asset protection mechanisms that make sure that you have ways to, prevent financial predators from getting your money? Do they actually do risk management and look at ways that things can go wrong and stress test it? And do they make sure that your assets are coordinated and working together? But most importantly, do they understand you and what you're actually looking for? See, I kind of have this like 5-step pyramid here when it comes to prosperity. Okay. At the bottom of this is perspective. If someone's coming from a place of ignorance and limitation or scarcity, they'll have a very limited perspective and they'll operate from either fear or greed, and they will absolutely not do their very best. The second thing is, what's
like
their purpose?
Scared dog backed into a corner.
Yeah, purpose narrows it down. For me, purpose is like, got to know someone's investor DNA. You got to know what their economic independence number is. You got to know like what their peace of mind is, when it comes to like what they're doing. And then when you understand the person's perspective and purpose, you could build a plan. Most people don't have a plan. They start up here. They go, what's the product and what professional sells it? To me, if you start with these two, you're going to be sold something. If you don't have a plan, someone else will sell you theirs. But if it's about you and what you want first and foremost, and you're understanding and educated, and then you narrow it down to what makes sense for who you are and eliminate the things that don't belong, then build the plan that has the foundationals and the essentials. You have the right car insurance, homeowners liability, disability, medical, and life insurance. You have the right corporate structures. You have the right wills and trust. You have the right tax strategy, and you're reviewing that every single quarter. And, you have the right cash flow reporting. You've structured your loans properly by having the right, credit score and connections. Like, that's the plan. Then you select the investments aligned with your investor DNA, so the product then only makes sense based upon your plan, and then the professionals that are expert enough to execute on this. Most people, again, just start with these two things, and most of the professionals are more salespeople than they are financial planners. So if all they did was set up a retirement plan for you, that's not a financial planner. That's a salesperson.
Yeah.
Right? And if all you have is asset allocation of bonds and stocks, you do not have a plan. You have a product.
Interesting.
And that's where my passion comes from. That's where this teaching comes from. Is like, I'm okay if someone wants to invest there as long as they understand what's actually going on. And it's not their only one-dimensional plan, and they're relying completely on a stock market they don't control.
But usually the big players are the ones who have that deep understanding.
Yeah, there's a thing called a family office. I think really probably coined by the Rockefellers, because they had enough wealth that they had a financial firm that worked just for their family. But in that family office, you got the family in the middle, right? Then you've got a CPA that works just for you, an attorney, someone that's an expert with cash flow, risk management and insurance, banking and right? Like, and all these people are cohesive. They're communicating. It's a coordinated plan. And you've got someone that quarterbacks this for you. And what a lot of family offices do is they'll pick an investment category. Like, I met one billionaire at a family office, and they're just amazing at gas stations. And that's where they make their money.
That's just what they focus on.
That's the majority of it.
Wow.
Right? And they're really good, and you've seen them. They're all over the place, and they know how to do it, and they crush it. They're not putting their money in a bunch of investments they know nothing about, or just in a bunch of other stocks that they don't have any relationship to. And so that's what the ultra high net worth do. But then the average person thinks that they're saving when they're gambling. And they think they're diversified, but they just have stocks and bonds.
Oh, gotcha.
And they're over-reliant on just stocks and bonds.
Oh,
most family offices will have real estate in their portfolio.
Yeah, I mean, that's an interesting
They might have gold and Bitcoin.
Because it's kind of it gives the appearance of diversification because you're invested in all these different companies.
Yes.
But you're not really, because you're like you said, you're using the same product.
Yep. This is how it works. And when I was a young kid, in my early 20s, I saw a family office for the first time, and I was fascinated. I was like, this is amazing. And then I was frustrated because I'm like, oh, I'm new. I don't even have a lot of money yet at the time. And I was like, how do you build a comprehensive team?
Yeah.
And a lot of times the team are at odds. My first accountant and my first attorney disagreed. So the accountant wanted an S corp, the attorney wanted an LLC, And then I had to unwind the damage they did when I got audited because they didn't do that right, because they didn't agree.
Oh, no.
It wasn't a big problem, but it was a nuisance.
Yeah.
And then you got some people that just are only real estate and other people are only, and they don't see eye to eye, and it's like at odds, and it's confusing. And that's where the complexity comes. So, for me, I just don't invest in the stock market because I don't have expertise there. I don't have interest there. I invest in my companies. I invest in intellectual property, real estate that I actually utilize, that can grow in value, that I know because of the uniqueness of the real estate. But I don't invest in a bunch of real estate because it would be outside of my investor DNA, So I've simplified my financial life. If we go back to my 20s, I had over 100 real estate properties, right? I owned between 20 to 100% of each door. Mm-hmm. I had 2 IPOs that I invested in. I invested in oil and gas. I set up a bridge financing fund and did development. I did too many businesses because I said yes to too many. I did some private capital by funding people. I knew their companies. And so what happened was I had no free time. Just managing all that was chaos. And I wasn't in control of a lot of it. I didn't have enough knowledge around a lot of it. So I was taking far too much risk, because risk is in the investor. What kind of investor are you? What kind of investments make sense to you? Which ones don't? And that's why, because it's not my investor DNA, I have no money in the stock market. Even though, my net worth's in the top 1%, I don't have to hold that in the stock market.
Huh. That's interesting because, people talk about, that's a risky investment.
No, risky investor.
Huh. And what's the difference? How would you define that distinction?
Someone that invests in things that they have no control of the outcome, no exit strategy, no way to mitigate or manage downside risk. They couldn't tell you why they're doing it, how it works, when it works, why it wouldn't work, all those kind of things. That's a risky investment for them. Some people are so good at real estate.
Gotcha.
Some people know how to analyze that real estate. They know the development. They know the area. Like I was just talking to someone that they know what's being built in a certain area. They know which hotels are coming in. So they're calling people that they aren't even selling the land just to buy the land because they're in that world. Other people, if that's not their world, how do they know? Are they doing that depth of research? Do they know what to do with that property? Do they have the connections or the contractors or whatever to do with that? I know people that are in real estate that when times are tough, they do round robin auctions, or they do fractionalized ownership, or they have so many different strategies. I have a client that, my first immersions, he is brilliant at going out and finding really good diners or restaurants that are easy to manage, like pancake places and burger places. But he buys the real estate in places that are desirable, close to the beach, close to downtown. And then he makes sure that the numbers work for the restaurant. So now he owns the rental, or he owns the real estate and the restaurant. And he goes in and he improves labor costs and changes the processes to make it more efficient, because a lot of them have been owned by the same person for 40 or 50 years. And it is clockwork. And he says no to good deals because he has his parameters. That is his investor DNA. And that's why he'll be a billionaire. Right.
So it's kind of a one man's trash is one man's treasure type thing, where
to a degree,
what one man's risky investment is another man's.
Totally.
Yeah.
And for most people, the stock market is risky.
Because they don't understand it.
They don't understand it.
Interesting.